This is a special report on the U.S. dollar. There's things going on right now in the markets, especially the repo market, that I think is important to focus on, and how that's affecting the dollar and other markets that we look at. The dollar is stronger as expected. We did think that the dollar was going to be moving up, but what's going on in the repo market is important to look at. The repo market, where they do the reverse repos, is how the banks basically settle up, big financial institutions. At the end of every day, they settle up, and when they have a lot of cash, they bring that to the market, and they make reverse repo deals, essentially, where somebody with collateral on the other side, usually like a treasury bill, then posts the treasury bill, and they make a deal. The banks then will essentially take their treasury bill for the excess cash and then agree to reverse that trade just in the next day or in coming days. So that's how this reverse repo market works. When there's a lot of cash in the market, then the problem is that there may not be enough collateral on the other side, which is the situation we have right now. If the collateral on the other side is not trusted, in other words, if it's like paper that nobody wants, like happened in 2008, then back then you had Lehman with a lot of mortgage backs, and of course nobody wanted those, so Lehman couldn't put those anywhere, and that's what was part of what brought the crush of Lehman during that financial crisis that we had. So that's not what we have now. What we have right now is a massive excess of cash in the market. The banks don't even know what to do with the cash, and the Fed tried to accommodate that, and they raised the interest rate to 5 basis points for the banks so that they could essentially park it with the Fed, and then the Fed would pay them at an overnight rate of 5 basis points. And what happened was it started to bring a lot of money into the repo market. So banks are not motivated to do anything else with the money because there's not really enough loan demand. So they continually every night bring that. And it got up to $1 trillion, which had technical reasons for that also. But it's pretty likely that the reverse repos are going to escalate well past $1 trillion now. You can learn a lot about this. I think that Stephen Van Meter, he's on YouTube, and I watch a lot of his videos, does a great job explaining a lot of this. And I learned a lot from him and other sites, of course. It's important for me to understand how these markets work. And right now, the markets are not working. There is a huge shortage of collateral. Now, what that means is that, well, for technical reasons also, the government hasn't created as many treasuries, especially bills, as the market really needed for collateral, because they were spending down their excess holdings in their general funds. So with all of the massive amount of money that they printed, it's clogging up the system in a giant way. They, like I said, they tried to accommodate that with a 5%, 5 basis point yield, but that essentially is draining money out of the system. The system can't go anywhere. The money can't go anywhere because the banks would rather get the 5 basis points. So the Fed is really stuck right here. They have to taper. And that is going to be very misinterpreted by the markets, I think, or it is right now, especially in the stock market. What's happening is that because there's this huge demand for treasuries, the bond market is flying. Yields are plunging down to about 1.26%, and that's gotten really much lower than we expected it to. But the Fed has messed this up really badly, and they're going to have to fix it. What are they going to do? They're either going to roll back that 5 basis point yield, or they're going to taper. They really are forced to taper because they have clogged up the system with way too much cash, and it's really bringing. If it is moving out of the market, it's moving into asset prices, and it's a bad situation that they have to fix. That's why you have strong bonds going on right now. If they taper, of course, it's going to make the stock market fall, And I think money is moving into safe haven of the dollar and of the bond market right now. And I just don't think investors get it yet in the stock market, but they're probably going to get it soon. And today's FOMC minutes may not be reflective of that, like I said, because they're kind of too old for that. So we're probably going to get that in the next meeting or the minutes following that. But the markets are acting like a taper. They know a taper is coming soon, all of them maybe, except for the stock market. So we're going to look at the U.S. dollar now, and then we'll look at the other currencies, and you're going to get a pretty good idea what's going on. So this is the monthly. I usually don't bring monthly to out to the public too much. It's usually for our members, but it's important to see this. This is the monthly dollar right in here. And we're looking way back here to about 2000. And you can see in here the big 41.5% plunge in the dollar right here as the yields crashed, as there was massive money printing back in the financial crisis. That's what went on right over here. And then the market recovered. You see the inverted head and shoulders right there? And that inverted head and shoulders breaking out of the neckline targeted right up here. And you could see it nailed it. It was a bullseye. Now it's been in a sideways correction in here all the way since 2016 that you can see. And the cyclical patterns on the bottom are really important to look at. These are cycle harmonics for those of you that are new. And the dominant cycle right over here is 80 months. The intermediate there is 40 months, and the minor cycle is 20 months long. These yellow ovals that you see right over here is when there is a nesting of cycles. We have those grayed out areas right in there. And when the nesting of cycles comes is when you get the biggest declines. There's a downward force. And you see that in each of these. The harmonic rhythms that you see in here are phenomenal. They're so good that I would say that they're probably up in the top 10% of quality of cycle harmonics. Now, if you look right in here is what we're looking at as I zoomed in, you can see that there was these mid-cycle lows right over here brought that big decline in the dollar. Back over here, I made a call that said that risk starts in July of 2020, and it's projected to go down and nest into mid-year of 2021. That would bring a decline from this point right over here down to this timing right over here. It was a total bullseye. And now where we are is entering into the rising phases. You can see there are 3 of them right in there that push up. Here there were 2 pushing up, as you could see, and you got big rallies. And here there were 3 pushing up, and you got a monstrous rally. I'm assuming that this is stuck in this triangular shape, and therefore I'm not giving it a massive breakout over here. I think it's going to trade up. Now the upward projections very minimally are here over the 94.50 or 60. Then this one over here is at about 96, just over 96, and this one here is just around 97.80 for the dollar. It is highly likely that the dollar is going to be moving up during this period. Now, if you watch the special that I did in Market Week last week, I showed you the relationship between gold and the dollar, and the fact that if the dollar is going to be moving up through this very period right over here, the very least amount is through mid-22, that's this minor cycle, then that would, be a tough time for the metals. And I think the dollar will keep a cap on the metals, though, they may have periods where they do okay, but this is really saying that it's not really a time to be buying metals when you look at this. This is just the beginning of this rising phase and a significant demand for dollars that I believe is out there. And the dollar is often a flight to safety when you have stock market that's moving down quickly. So that is a situation that's important to look at. So now we're going to see just 2 months into this rising phase, and now we'll look at the shorter terms as we finish up this analysis in the dollar. So here is the dollar on the weekly chart, and you can see the cyclical harmonics in here also. They're at 50 weeks and 25 weeks. We have people that write us, well, what are the cycle lengths that you put in there? Every single symbol has its own energetic movement, its own flows of money, and we do this manually to see where those are. And you could see the important low right here, right here, right here, here, a little bit off there, but not much. This is anomalous because it made a big diamond, and this is when the COVID panic hit. So it moved a lot in there, but you could see the cycle rhythms, how they work out, and the low that came right there. So now I'm going to take a closer look, and you can see in here that we have some notes in here that are reflective of the relationship between the dollar and the euro currency. Because the dollar is inverted to the euro currency is 57% of the dollar index. And this low occurred here, right over there, a little bit on the early side, and then turned up. It's very clear. The shape of cycles tell you the conditions. So here we are in this rally phase that the dollar is in, and this is that area up here, which is around 94. This is around 94.60. So it's pretty likely the dollar is going to continue to move on the upside. These are supports. If it happened to pull down, that would really be buy areas for it to move up again. So the dollar is in very strong shape when you look at this. And I would say that it looks to me like it's likely that there is going to be some continued upward pressure when we look at this. I think it looks very strong to me. Now I'm going to switch over and look at the daily chart right over here. And you will see that this also has the cyclical harmonics in there. This is a very strong cycle that you see right over here. I want you to note the slim ribbon. When the slim ribbon was negative and showing you negative momentum, the slim ribbon PO was giving you the signals. These are signals that say a continuation of downside movement is likely, as you could see. And then it turned up right over here. The momentum turned green, and now you could see the signals coming that tell you the likelihood of a continued upside move is very strong when you look at that. So everything that we look in here is suggestive of upside dollar movement. There will be some correction, but then when that's over with, it's likely it will be moving to the upside again. So that is a look at the dollar as we look at what are out of phase cycles in there. Some of the cycles line up perfectly, some of them act out of phase, and that's what's happening in here right now. And when they're out of phase, they work against each other sometimes, or sometimes with each other. And you can learn a lot about that in our cycle analysis workshop about cycle phasing and how they act when they are in phase and how they act when they're out of phase. And the total of how they work together or against each other is called the principle of summation. And you can learn about the 8 principles of cycle analysis in that workshop. I know there are many people that have already taken that workshop, and I always like to refer to things that's in there. So that's a look at the dollar. We looked at the monthly, we looked at the weekly, and we looked at the daily. I think all of this is very important to be focusing on because it's going to make a difference in all of the markets that we look at, really, this dollar strength. And what I believe is a problem that the Fed has created that they are going to have to adjust. And when they do that, it's going to be significantly moving, I think, a lot of the markets when that happens. They have made a big mistake, in my opinion, and I think a lot of people that I consider to be very learned are speaking of that. So dollar strength likely to continue.